to state the obvious. The economy fell into a deep hole at an unprecedented speed in late March 2020. When we were talking last year at this event, we were talking about maybe a slight slowdown this year. We were wrong, but we also noted that we don't call black swans, and this black swan event was at an unprecedented scale. All right? So what I'm going to do here today is I'm going to walk through what happened, where we're at, and where we're going as we walk through 3 segments of what has happened over the last year. So the first of those segments is the virus and the public health response dug the hole that we're in. All right? We had a massive public health crisis, and in order to make sure that hospitals were not overwhelmed, to make sure that the elderly remained safe, to make sure that people didn't die, we had to slow down the economy in order to get there. We can see that because by mid-March, we already were starting to see some restrictions on gatherings, just 2 months after we met last year. And by the end of the March, it had advanced to some level of stay-at-home order across almost every state in the United States. But each of these stay-at-home orders was completely different. So in some cases, it included construction. In other cases, it didn't include construction. Michigan was one that didn't. And in fact, recent studies have shown that the shutdown in Michigan was more harsh than in any other state in the union. And a lot of that had to do with our surge in cases that started in Detroit. All right? The second problem that we have is almost every place where we have gotten it under control, we see a second jump in cases. And often those start in places where people gather, like nightclubs and bars. So this is the quick pandemic graph. The orange is the United States, and it's off the right axis. The blue is Michigan, and it's off of the left axis. And this is the number of hospitalizations. We use hospitalizations because it is not affected by the number of people getting tests. If you're actually sick enough to be in the hospital, you're in the hospital. If you're not, you avoid the hospital. You avoid the hospital like the plague. You don't want to be there. So it's a pretty firm number. We can see that early surge, and you can see in percentage terms, that jump in Michigan was much more severe than it was in the rest of the country. All right? Then you can sort of see this second surge. That's actually not the second phase. That's just the virus moving across the United States. And then as it started to get cold in the fall, you can see Michigan started to rise, and we peaked at the beginning of December, and we've been dropping ever since. The rest of the United States is continuing upward. So how did this shutdown that we had in order to have that nice long summer with low numbers of COVID, and those low numbers of COVID really allowed us to take advantage of the spectacular summer weather that happened this year in Michigan. That summer weather likely will have saved businesses, several businesses that might not have made it through the winter. All right? So this is what happened across the United States. You can see that employment drop down 14% on the service side, down 12% on the goods producing side. And you can see by June, as we started to lift those restrictions, we made it back up to about halfway to where we started. And then we've had that slow improvement over time afterwards, which is what we typically see after a recession. So we started to move past that initial shutdown phase. But in Michigan, where we had a harsher shutdown, just remember, take a quick look, minus 12%, minus 16%. Here's Michigan, down 25%, down almost 35% in that same time frame. That's how tight we held down the economy in order to get those nice low numbers all summer long. All right? And you can see that as we came back, that realistically, as we started coming back in June, because the numbers were low, we started to see improvements in service as well as good producing. So we're still a little off compared to the rest of the country, but we came back pretty strongly, and we're there now. Now in December, we started to see service producers start to fall off again, both in the United States and here. as that second surge really started to take a grip on the economy. All right? So our second phase that we have to talk through. Some industries are already out of the hole. However, not everybody. So one that never really went in the hole was residential real estate. If we look here for the numbers for Kent County, you can see that the price indices continue to go up. Realtors continue to talk about multiple bidders on houses. And we can see that even downtown zip code, 49503, right downtown in Grand Rapids, we didn't see a drop off in the price indices, which means people weren't fleeing downtown in order to get away from the virus. They were buying in. So we continue to see that. You can see a little bit of that fleeing in the Grand Rapids Township Cascade Plainfield number, because you can see those prices really start to jump as we got into the third quarter, as people were trying to move into a place with more space. All right. So what we saw was residential real estate really continued to tick along without a lot of problem. Manufacturing ended 2019 in a shallow recession. You'll remember me talking about that last year, maybe. All right. You can see that here. This is the orange is the 12-month moving average. The blue is the 3-month moving average. So what we can see is those short-run averages drop below zero on the Purchasing Managers Index across West Michigan and started to pull down the long-run average. This really started to slow down manufacturing as we got to the end of the year. And then as we started the year, it started to turn the other direction. We started to get out of it. And then we had the shutdowns. And we had a massive drop in new orders for firms. But look at the last half of the year. New orders have been strong all fall long, all beginning of the winter long. We're starting to hear some anecdotal evidence that at the end of January, at the end of December, things slowed down a little more than they expected. So we're still waiting to see whether that's just that everybody collapsed at the end of the year and took a breather, or whether that's that the industry is resetting. But what we can tell you is automotive came back strong. We started the year near 17 million units on an annualized basis. For the year as a whole, it will be 14 million units, but we ended the year selling above 16 million units on an annualized basis. And we expect it to stay that way through the next year. So that came back almost all the way. We know furniture has started to slow down even more, and that has to do with a lot of the uncertainty about what an office is going to look like in a few years. On top of that, office furniture is made really well. If you need to conserve cash, you wait to buy office furniture. So we're seeing that, and that's affecting the other side of manufacturing here on the west side of the state. I don't have to tell you, restaurants are still in the hole, and any service provider who is customer-facing is facing this. But I want to show you this. During the shutdown in April, year-over-year changes in sales in restaurants for the United States was down 50%. All right, down 50%. And we had on the order of 40% of restaurants in Michigan closed. The rest were providing some sort of carry-out service. All right? By the time we reached June and made it through the summer, that beautiful summer where people could eat outside, we had 18 to 20% of local restaurants closed. This doesn't include the big chains. They're on a different game. But those small restaurants, we saw 18 to 20% of them closed. And we were doing pretty good. We continued to see improvements through October, and then the second dip started. So as we sit here today, we're right around 30% of local restaurants are closed. So we're guessing somewhere between 20 and 25% are closed permanently. And how fast we get to the end, how good PPP is, what the second tranche of stimulus as President-elect Biden becomes president will all affect those numbers. And we know that when we asked you across West Michigan, this is what we got back. 42% of businesses said they would be back to pre-COVID levels by the end of July 2021. but 22% said they wouldn't get there this year. So we have a story of the haves and the have-nots. There are certain sides of the economy that are running along just fine, and there are certain sides that are halting and having problems. Well, let's get to the last phase. How fast will we climb out of the hole? Right? Remember, this is virus-driven. The virus numbers matter more than the economic numbers. So the first thing we have to worry about is getting rid of fear of the virus. And if we are lucky and we stay on track, it's really looking like we might have a shot for that as we get into summer. But here's the other side of the story. The government did something that we did not expect, and we've never done before. They really gave a ton of fiscal stimulus. All right? And you can see that here. This is disposable personal income. This is income after taxes. All right? Income after taxes. If I drew this line all the way back to when the data started, you'd see this nice smooth line cruising along until you reached April of 2020, when it shot up. Shot up. This is the $1,200 checks. It's the extra $600 a week in unemployment benefits. It's PPP. It is a ton of money being dumped into the economy. And you can see as we went through summer, people's incomes remained elevated. So it wasn't until those 2 months, 2 to 3 months here at the end of the year in 2020, where we started to have a drawdown on that, as we had an end of some of the stimulus programs. But if we look at personal savings, what we can see is that we ended the year almost double what is normal. People had about twice as much income sitting at home as they did before. And we know that that also affected lower income people, because we saw that their checking accounts had more money in it at the end of the year than they did at the beginning of the year. All right? That is big, big stimulus. That doesn't even include the next stimulus dollars. And it doesn't include stimulus dollars we expect to come online. Economists right now are expecting about another $1 trillion. And we know that, that President Biden has asked for more than $2 trillion. So someplace in that game, we will see another grouping. Think about that. That puts us at $4 trillion. That's almost equal to normal government spending. And it doesn't include any of the other programs that we have. All right, think about that. That's a big number. We haven't seen that type of increase in government spending since the Korean War. And the last time we had a bigger hit than that was 1942 and 1943. All right? And if you don't remember 1942 and 43, we were building a lot of ships in order to go to Japan and Germany. All right? So when we ask people across West Michigan, you can see that happening. You can see that nearly 50% of the people we surveyed across West Michigan said that they would be hiring faster than 3% this year. We're looking at national numbers between 4 and 5% job growth. We're looking at national numbers of GDP growth above 4%. But on the other hand, we still have 22% saying they're shrinking this year. So we have firms that are doing really well and firms that are doing relatively poorly. So here's the forward risk. So remember, you always got to watch out when economists start talking 1 or 2 or 3 years in the future. But here's what we're seeing. As we look at things, a lot of this debt was already monetized. We monetized it by the Federal Reserve buying treasuries and bonds and things like that. So the government spent the money, they issued debt, that debt was bought by the Federal Reserve, which turned into money. That money hasn't created inflation because nobody's spending it. If they start spending it anywhere close to the way they used to spend it, the potential upside on either prices or interest rates, and which one it is the Federal Reserve will get to choose, is very, very high. In fact, the probabilities that we're looking at in the model that I use show the probabilities for price or interest rate increases are greater at the end of 21 and 22 than they were in 1982 when I had a 14% CD. So we're not claiming 14% CDs. We're not claiming massive inflation like we saw in the 1970s, but we certainly will be seeing a point or two higher than we're used to seeing. And we have an entire generation of professionals who have never seen inflation above 2%. So 3 or 4% would be a shock to how they think about it. So what to do? Watch hospitalizations. Don't watch unemployment. Unemployment across West Michigan is 4% right now. Does it feel like it? All right. Don't watch unemployment. Watch hospitalizations. As those start to drop, the ability to move around will increase. Do watch passenger miles and border closures, because that will tell us whether economies are reopening so that we can start moving faster. Part of our constraints right now is we can't get parts to build things because the supply chain is crunch. All right? And I never watch consumer expenditures. Consumers are the last to know anything is happening. Now I am, because they will be the trigger. If we get to fall and you start seeing an increase in consumer expenditures, then you can know I'm right about inflation or interest rates. If you don't see that, and people don't get out of the fear, then you know you have some more time before that starts to build in. All right? So I've walked through 3 steps. We had a crash. Most of that crash was returned very, very quickly. Over the summer, many things healed, and we started to know the winners and losers in industries like the restaurant industry. And we know that this is going to be a strong year no matter how you look at it. There's going to be a lot of economic activity in 2021, and we're going to see growth like we haven't seen in recent times. So, U.S. and Michigan economies have already scaled most of the way out of the hole, but it will be 12 to 18 months before we feel like we're on solid ground again. So be looking at the middle of 2022, and you'll start to see where the new land is lying. Thank you.